Span. Oh shit, this thing. Timing away is bad. Timing window is bad. Ah shit. Huh? Okay. So these are the monthly supply levels. So firstly, you need to analyze the monthly time frame. In each and everything that you do, you need to understand what is happening in the bigger picture. Even if you want to scalp it, even if you want to day trade it, you need to understand what's happening in the bigger picture. So right now, I've analyzed the monthly time frame. I have looked at the supply levels that are fresh. This is the supply level. This one wasn't drawn because it has been taken up by this one. This one just reacted a Moyen right here. This is a SR flip. This one is fresh. This one was a hidden base. It is also fresh. It was recognized as a supply level because of the fact that price has been pushing down and creating lower lows. And that signifies because this price right here broke this structure, and that's why this one is like this. That one right there, before it broke the structure, it broke these ones and then created this one, but eventually broke these ones. Same applied with this one. When price went up creating this high, this one is broken right here. That's why this compression right here resulted for price to spike up like this. I was saying about compression. Now price is being held inside here. So we know for a fact that in the monthly time frame we're red. So let's go find out what's happening in the weekly time frame. In the monthly time frame we're red. So that's how we get to analyze now. We're breaking it down because price is not at a demand level or from a demand level. It's from a supply level. So you do the same thing now. I differentiate in the weekly time frame. I use line instead of the zone. So I've noticed to say price reacted at this supply level right here. This is the rally base drop. Then price when came back to that zone, it reacted to create its own rally base drop. It wasn't fully penetrated until price reacted to it then. Now, this is the only supply level that is left within this zone. So price, after that, bear in mind, this was a high, and this is a high now. This is a high low. Price created this limping leg again, down here, which caused price to react at this level. Now price that has reacted at this level, what does it mean about price? It means after price reacted here, there was a structural break here. This supply has been tested here and has been tested again, and there was a structural break. It's a confirmation to us to say price, remember, created a high, now created a high. This is a high low. This is the next demand level that we have of price. Looking inside here, in the past, we could see the amount of pressure that has been put by price when it gets this level. Either side, on the bullish side, on the bearish side of it, price has been exerting amount of pressure. So right now we're looking at this. Now that's why we need to focus at this point now of the market to say what is exactly happening within the market at that very much point. Then we'll go down to the lower time frame, which is the daily time frame. On the daily time frame, what can we see? We see that there was a supply level that hasn't been tested exactly the way I had anticipated. I had said it has been in the weekly time frame. That's why we need to do a top-down analysis. As you could see, this is a rally-based rally, and the decision point was made here. This is where price engulfed drastically. It reacted to the support in the previous price tag, same as within the hidden base. You see, so I can't try to describe each and every term that I would use to read the price, the price action, because that's what is being sold. You see, so I can't necessarily define what's a hidden base, but this is a hidden base, and as I flip, but you could make sense out of it by looking at price, or if you have experience of price. You see, so now there are two things that has happened with price at this very moment. We know we are bullish. No? Everything seems bullish because of this. There was a structural break, and price has reacted to a demand level. This is the demand level of previous price, as the structure has said. A high low, a lower high was engulfed, another lower high was engulfed, and price is not held at a true supply level, meaning price is supposed to come and react at this demand level that he had left. That's a swing trade right there. Price has to bounce inside here and then push up high. What's the market pattern that confirms that? There's a key level right here. When you're looking in the past, there's a key level right here. And price created an over and an under right there. And then this is the decision point. So you scale down within this decision point at the lower time frame to find another key level in this point, to say where was the next key level within this point that would actually cause price to react. Or you could just use a shortcut like this, depending on the skill set that you have now. By the time you go down to the line graph, you would see that this is where price has been bouncing off. So what is it that you need to do? It's just adjust that, probably put it above to ensure your orders get filled. Now you have got this touch, you have got this second touch, and you have got this third touch. Understand? So now while you have these touches, now you know the fact that, okay, now this is where most probably the decision point is at. But the question is, are we going to wait until price get there in order for us to get involved with this pair? Yes, we've got a swing trade, but right now price is here. And by the looks of these candles, price is compressing. Where is it going? Exactly. Because it's not going to go there. By the time it gets there, it means that it will be from here. There's this hidden base right here at the daily time frame. That's the hidden base that we're talking about. This hidden base is aligned with a structural level within price tag. This is the hidden base right there. When you look into the past, how many touches does this price tag have at this level? We have got this one. We've got this one. We've got this one. This one's this one. This one's and this one. That's a key level. And now you have got a drop best drop supply level within this level. That's the same thing I had explained on the previous session. So now we're going down to the lower time frame to find exactly what is happening. So what can we do? We can just mark this now until we find a pattern that we can trade at this level in the past, in the lower time frames. Then we would stop there. There's a drop based drop. As you can see, this is a drop based drop, but that's not enough for us to get involved in this market. That's another one. Still not enough. Here's another one. Still not enough. 15 minutes. Okay, what is it that we can tell from here? From what we can see here, now I want to adjust this. This here is a key level. Now it's the maximum pain level that I was talking about. Maximum pain level being something like this. I'll just make a brief description. Price create resistance, bounce back create another resistance, create a low, create a high, create a low. That's another KOU. That's an over and an under. That's the market pattern. This is the same thing that happened here. This is the low, that's the resistance, and this is the over, and that's the under right there. Okay, we have that. Then what confirms that price will react? Because you talked of compression on the daily time frame just by looking 3 candles. Okay, this is what we call the golden zone. So we're looking to trade above this zone. And we're only considering to trade this part of the market from this line until the high of the pattern, which is here. Now, the price reading, that's where it gets intense. Where it gets intense is whereby price, you see from here, this is the low, this is the low, and this is the second lower low that was broken, and this is the high. So what is price exactly doing? Now, when we take this level, exactly from this point, we're supposed to see something in the future. We could see this. There's a resistance at this point. So we need to adjust this level because the resistance is not a specific point. It's an area, you see. This is the resistance. So what can we tell from this resistance? This high has been engulfed and price is bouncing at this drop-based drop right now. What does it mean? It means price created some sort of a resistance, another resistance, and this is a SR flip. So with this SR flip, support and resistance traders that will sell here, breakout traders that will buy here. And what will happen? Our anticipation is that price will fake out to this point whereby there is true supply and demand and then go down. Where's the next demand level that hasn't been tested? This one. But we know that we're looking for buy then, Lapendas. You could be greedy enough to take it to this demand level, another one. So if Ungana 0.02, you can take the first 0.01 here and take the other one from here. Now you're out of the market. You're waiting for price Lapendas Lapa to swing it. So you've got an entry point, you've got a TP. Stop loss. How can we find the stop loss now? So if we're looking for stop loss, where was this held? It was held by this decision point right here. This decision point right here of this hidden base. So we take it to this now. If you are not sure enough, you could even take it here. To say that's where your stop loss is at. You see? But that's too wide for my liking. I'll just take it here where the decision point was at. So what do I have? I have a risk reward of about 14, let me say 15 pips to 84. 15 to 85, to 85, my mom. 85 divided by 15. That makes it 5. Risk reward, 5.6. Meaning if you're risking 10, you get back to another $50. Now you've got 2 trades that amounts to $50. You've got $100 with 2 trades. Risk management, risk reward. I'm done. I think now let's have a conversation. If somebody wants to ask something, then I would have to explain it. Unmute yourselves. Isalego.
Hayi, siyabonga Nkosi. Kuyabonakala nedi nje singavele sibukabuke kutawugcine kulungile. Ngezibambe first time ngibe practice nje lemculo.
Yeah.
Nkosi.
Because at first you need to understand the pattern. When you understand the pattern, then you have to backtest the pattern. Give yourself time. I could show you in my charts that I've been backtesting the patterns that I'm talking about, that I'm saying you should be looking for at this specific levels. You should be looking for, because trading supply and demand alone is not enough. You need to then, after you've identified that supply, that demand, look for a certain pattern that approves to what you're saying. I was talking about maximum pain level. I was talking about a KOU. I was talking about a SDE. I was talking about a 2RFL. You see, so those are the things that you need to take into account when you're talking about a 2RFL. Just that I don't think I have an analysis where I have a 2RFL. 2RFL is whereby you have two resistance like this one, and let's say we are bullish in this case. We have two resistance like this one. There was a supply level right here in the past that has been engulfed now to create this new low. That's a 2RFL. And then you only trade in this part that is beneath the golden zone. The golden zone starts from this to that. That's what we when you're talking about 2RFL. No, now when you want to buy, you know you have got a 2RFL pattern that you need to look out for at a supply level. So after you have a 2RFL, you could also look for a KLOU, which is basically what is known as equals mode, but it has been modified so that you get the sharpest entry and risk reward as possible. You also have things like an SDE. That's the best setup you could look for when you want to sell an SDE. A combination of these two when you're selling the market, it's a high probability setup. The PA, when talking about PA, we're talking about 3D. Someone will say, this is the 3D. This is the first one. This is the second one. When price react, it will break this resistance to test here, and that's the third D. You see, they all have rules, which I can't go through all of them at the same time. There is also a resistance level. I like this one because eventual price fake out like this and come back to your take profit. There are different kind of fake outs. There are three different kind of fake outs. It's whereby price will come back here and drop like this, then react like this, then do like this, then go back to the true decision point and then go. There is a fake out level whereby price will store, create resistance, and then shoot to the true side and then to the downside. The other type of a fake out is the fake out whereby price will then create another pattern beneath this one, Lela Petu. Let's say there is a pattern right here that price is supposed to fake out to. Price when it gets back here, it create another one like this. People that will sell here thinking that's a true, but you see, there wasn't a structural break. That's not a true setup. Price will just react a little bit here and get liquidity, then go up there. Then you are shot. Those are the things that are being sold to say you need to know the rules and you need to know the tricks. You see, you need to read the market to the finest details. If we if we want to find the sharpest entry point at this level and not and at this level and not just look at the supply and demand of the higher time frames, because that's the shortcut. You could go down to as low as a 1 minute to try to find out where price hasn't reacted fully. And if you find price that left supply here and then continued like this, there's a high probability setup that this supply level that has been tested, when price return, it will engulf all those supply level until that point, and then it reacts. That's the methodology about price. That's how you get to read the market. That's how you get to perceive. Like when you're looking for a target, at this point, this is where the target hasn't been done. This is that demand level that has been tested. This is a high low, and this is the high high. As you could see, price turned at an SR flip here. This is another demand level. Like I said, there are two demand levels and there are two take profits. This is a 2 RFL. This is just a flag limit, and that is the rise of it. So you need to focus on the trails that have been left by price in each and every instance when you analyze the market. You see, when you analyze the market, don't have the bias to say, I want to buy or I want to sell. Just be neutral. Let the market show you what you could see. Like we saw a swing trade on the high time frame. That was the swing trade on the high time frame. To say, okay, this is a swing trade, but EI price at this very moment. The price like yakhona la sikhuluma ngakhona, this is the same hidden base lebesiyibona from the previous higher time frame. Now what can we see? It confirms now price has been bouncing at this, forming a resistance, and now this is the same price compressing away. There was a first D, this is the second D. Price, by the time it retraces here, it will be forming a third D, reacting to a demand level somewhere inside here. When price react to this demand level somewhere inside here, or this one right here, that's where you get to have your entries. You will either have it here, anticipate here, or anticipate there. Then you shoot up. Where is your next target? This supply would have been taken out. This is the next supply right here. So let's say you have an entry alongside this level of supply, and you have your take profit here. That's around 30 pips, and you have a stop loss of about 60 to 330. That's 5. You see, all our risk reward are basically around 5, but the minimum risk reward you should take, it's 3. What do I mean by that? When you have 3 trades and you lose 1, and you lose both of them and win only 1, you still haven't lost money in the market. But if your risk reward is less, then you have a potential of ruining your capital. In instance, you could lose 2 trades but still be on the winning position, because if you're risking $10 in each and every trade and you have deposited $100, what does it mean? When you lose 2 trades, it means you have lost $20, but you won 1 trade. You still $10 plus. Is it? Because if you risk 10, it means you'll be getting 30. And you have won 30, and the $20 go 30 uvala the negative side, and the $10 is the plus. So it doesn't have, you do not have to be right for you to make money. You just have to be smart. Understand that each and everybody participating in the market, they are smart. And everybody is against you and willing to take the money away from you. So you need to trade in a way that conserves you from the market and the market taking money away from you. Any question? Any question?
Now someone done a question about Quaido.
My network
Odoro.
isn't good.
Yeah.
I got lost on how to, on the last part where you were explaining about how to put your stop loss. Stop loss. You look at market structure, the previous high, that you anticipate that price shouldn't break when it comes to react. What does that mean? It means you putting it at, let me explain this. Stop loss, you put it where you know for a fact price is not meant to reach and it's hard for it to reach. and your take profit, you put it where you know for a fact it's easy for price to reach. But most people, they intertwine that. They easily put they just intertwine that and makes it hard for them to make money. Like we could see in this point. In this point, there is a decision point that was made here that caused price to create even those lows. There's this hidden base right here that reacted price at this very moment. Why? When you're putting your stop loss, you're putting it here. This is the high of where the decision was made on the previous price. On the previous price tag, this is where the decision was made on this high right there. And that's where your stop loss should be at. I understand. So let me go and focus on the high time frame one, so that it will be easy to see. We're left with 10 minutes. On the lower time frame one, when we're looking to buy price, we're looking to buy price at this level. That's the cheapest level I would go for. But if I have FOMO, I would use this one right here. Then let's decipher stop loss. Stop loss, let's look at the decision point where price reacted. It's the blue one because that's where the high was at. So this rally-based rally, so your stop loss is supposed to be here at the week of the rally-based rally. You understand? So it's outside the decision point and it just gives you enough time. If you don't have enough capital to allow your stop loss to run this high or this low, like for instance, you don't have enough money to risk $83, 83 stop loss pips. So what you have to do is from here calculate 10 pips outside. That's 10. You calculate 10, that's 10 pips outside the now. After you have adjusted that 10, now you think that happens, I would take it. I've got lesser distance that price will travel at, and I've got a greater distance if I take it at this point. But if we do top down, does it allow me to take where I want to? I haven't done the top down in this one, so it's just a mere looking at it at a support level. So you do not know exactly where price actually had its price tag. You see, this is a demand level that hasn't been reacted on. But price reacted to this rally-based rally here in the past. And this is where you could have your first entries. So if 70 is a 0.03, you could use 0.01 here, 0.1 here, and 0 here, because you didn't want to miss out. You see. So that's one form of ways to get back to you. Look where the price is, the trend line. Because price, it went up there, it will just come back here. Probably come. This is where it's most like, that's where the first cross is at. You should look at the points whereby price is most likely to do that. Understand? So, and another thing, your entry within this demand level, this is a daily demand level, that whole blue thing, daily and week. You should focus and scale yourself to say, I'm willing to be inside at this point, willing to be. So there are certain people that are very, very aggressive that will take their entries at this point. They do have the money to allow price to go down as low at that point, while they haven't felt any form of stress. But if you are someone like me who hates drawdowns, you will top down analyze this zone until the 1 minute chart so that you clearly read what has been done by price before it eventually engulfs that decision point. I think you are answered. So next question. I've got 5 minutes before this session ends, so let's make it snappy. I think we're done. If nobody is saying anything. Chama cham. Say something. Kwadu. Odu. You're welcome. So I think that's about it. I think that's about it. About the money management. Let me try to summarize this in the next 4 minutes as quick as possible. Money management, it differs from one person to the other, depending on the money that you have and willing to risk within the market. The market perceives you with a lot of information and a lot of opportunities to either make money or lose money. So you are only capable to control what you can give. You can never control of how the market reacts to you, on how the market behaves around you. So the key basic thing is to ensure that if you have $100, understand that in each and every particular month, you have to, in order for you to have a long-term survivor, risk $20 per month. If you're risking $20 per month, it means that you have 5 months still trading $100. In this $20, how much are you willing to risk per trade? For instance, kulo $20 for 1 month, you are going to risk $5 per trade. Meaning, with the risk rewards that we're looking about here, it's somewhere around 1:5. Meaning, you're making $25 per trade. That's a lot of money. That's 25% gain. In every business, there's no way you could make 25% gain in just one sale. Even a MacBook, it doesn't mean the way it's expensive, you get a 25% gain from, they get a 25% gain from Apple. So you taking that kind of direction, there's this what you call 2% risk rule, that in each and every trade, you're risking 2% of your account, your whole account. But in that specific month, you'll be risking only 6% of that account. So if you have $1,000 account and you are risking 6%, the 6%, within the 6%, you're still going to risk only 2% of it until month end. That's how you get to have a long-term survival. When you create your risk reward or your risk management plan or your whatsoever cash flow plan, that how you planning to generate your money, the first goal, you have to aim for a long-term survival and a steady growth and then making high profits. Mistake that everybody do, I once did. It's good you just try from creating that kind of risk management plan, you're just gunning for making high profits, which is merely impossible to do because you still have to adjust to the system. Because trading a demo account is completely different from trading the real account, because now emotions are involved. Now this is real money we're talking about, and now it's the real market we're talking about. Because then you could try to abide by the rules, because now it's you being disciplined in each and every trade, it's you being disciplined in each and every day, and it's you being disciplined in each and every rule that you have made. I think we are done. So if there's something I left out, you can check me out on Facebook, Noel Kwane Twala. I'll respond to you every day.